Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Wednesday, and we're now at February 27th, 2018. Boy, those days are going by. We're going to be in March soon, and we're just after 2:40 p.m. Central Standard Time. Well, today the problem was there were so many people on TV on Capitol Hill actually talking. We had Robert Lighthizer, and if you were listening to what he says, remember, he is the president's what? Hawk. He's very anti-China, known to be that, rough with them. So he came out giving you all the bad news today. He'll leave it to the president to smooth it out, but it doesn't sound like they're close on enforcement actions and the like. And yes, as he put it, they'll buy a bit more tons of soybeans. So what? It's the other issues. Well, if you looked at that, that didn't help the grain markets that much, so they were down. The interesting part is energy stayed up today as OPEC is saying no to the president on his tweets. They're going to go along with their program, which is a gradual reduction of production. Saudi Arabia going down to 7 million barrels a day. The stock market, listening now to Michael Cohen all day, Jerome Powell earlier in the day. And the question with Mr. Powell, and I was just on Fox TV mentioning it, I said, you know, I don't understand why people are taking that the Fed is coming up with its plan for the roll-off of the balance sheet as friendly. I don't know that that's the case. The bond market down 1 in 9/32. You're down in the notes. Now, when they drop, it means real rates are going higher. And this market added to that at this point, and it's been weighing on the stock market a little bit. So, interesting parts. When you take a look at the weekly chart of soybeans, we continue this erosion gradually down. And as I've said, I wouldn't be surprised if the market tries to get down to the 18-week moving average of closes. It comes in just around the $9 mark. And that would sort of put it neutral at that point, trying to figure out what the next leg of the market will be. When we look at today's action on the bar chart, we have what's called an inside day. So the market stayed within yesterday's highs and lows. In terms of chart pattern, you have a higher high and a lower low. There is no trend. And out of this, the only trend that I see that could happen is if you got under 912.25, you then have the potential for lower highs, lower lows. That would be bearish. Where's the market fighting its battle? Right here at the 100-day average. We had talked when the market was back here that if it slipped back, it could be the 18 to the 100-day. And as you can see, that's what the market is now done. Again, if you take this number out, that 912, I start looking to see where the Bollinger Bands are to see if there's another level of support. And they come in at 911.25. That's not very far away from that. And often, the first challenge of a Bollinger Band sort of stalls the market out. So I'd be a bit cautious. On rallies, resistance at the 18-day average of closes. Momentum is not giving us a clue. It's sort of drifting. If I had to say it's giving a clue, maybe it's got a little bit of a bearish bent to it, but that's about it. When we look at meal, I have the opposite. I have a market that is trying to correct an oversold condition. You can see how momentum's trying to lift. The problem is what we call this line in the sand, that 18-day average of closes in red. That, when the market has been going to it, has been offering the resistance. The support's been coming in at the lower Bollinger Bands. The trend of the market is down. The bias is down as I define it because it's under the 18-day average of closes. Could this market flip to bullishness? Not on this pattern. And the reason is you have a lower low. Even if you took out 312.30, you just have a higher high. So the bear pattern people are still in control. This is no chart pattern. Again, this is a higher high, lower low, momentum pointing down, bias down. I wouldn't be surprised if we just start hanging around that 18-day average for a bit. In the corn market, you can see you had that one rally when we heard on Sunday night that the president was giving an extension to the Chinese, and ever since then it's been down. And as I said, Mr. Lighthizer didn't help things. Now, I'm also noticing that Bayer, what we call them the Bayer Aspen, but they're one of the largest crop seed people in the world. And they came out predicting the corn acreage is going to go up 3 to 4%, as bean acreage falls anywhere from 4 to 5%, and cotton acreage picks up some of that bean acreage as well. In other words, bean down, but talking more corn acreage doesn't help this market, and you can see how it's leaning on it. In the wheat market, we've got the patterns of lower highs, lower lows, and embedded reading. Sorry to tell you, it's just a bearish chart. In the sugar market, this is a type of pattern that can surprise people if you take out the 1280 level. What it could end up, you've already got the lower highs, lower lows, and if you take that out in short succession, you can get a bit of a burst to the downside if it occurs. Now, we'll see if I'm right or wrong. Obviously, the one thing that could happen is you take that number out and then you reverse back up. But I see layers of resistance that I said yesterday. All you did is go into them today. In the coffee market, you're still very much in a downtrend. I keep my eye on the slow stochastic, which, yeah, it's trying to turn itself up a little bit, so there might be more of a rally coming. But until the red line closes over 20, the bears control the market. If that happens and you were to get that number up over 20, you'd probably clear the 150 area, putting into play the potential, I'm not saying it would happen, but the potential of resistance at the 18-day average of closes. Cocoa market, just a son of a gun. You've got lower highs, higher lows. It's playing between the 118-day average of closes. I will hear if you get under this 2240 and not take out this number now at 2336, you'd have lower highs, lower lows, and you'd put into play the lower Bollinger Band. Let's assume it rallies from here. I have pretty strong resistance at the old high here and the Bollinger Band. In the cotton market, is this where the market busts through this 71.30-91 level? If it did that, you'd end up with potential of lower highs, lower lows, momentum probably turning down, and you put into play the lower Bollinger Band. What stopped the rally is obviously hearing some of the talk where it's going to get increased acreage, maybe at the expense of soybeans, where cotton can be planted like that. In the cattle market, you continue a move to the upside. You are overbought, but this is riding the upper Bollinger Band in an uptrend, upside bias. In the feeder cattle market, you ended the downtrend yesterday, and today the market followed through, and I'll show you. This is how you looked the other day. Then if you took out that high, which you did, 100-day average resistance, what do you think the next number is if you go up? I'll call for the upper Bollinger Band. That's about where you're at. You're overbought. I think pros are taking money off the table up here. We'll see if I'm right or wrong. One of these times, this sideways action is going to act as either a base to really kick prices up or a top to drop them down. I'm aware of that, so I'm keeping my eye on it. In the hog market, you've negated the downtrend. You know, you had been leaning here with this oversold condition, never did embed. Market had a rally yesterday, and now with this follow-through, you've taken out that high. So you have higher lows, higher highs, which is countered because you closed under the 18-day average of closes. When you do that, I give the market downside bias. Where it closes in the relation to that 18-day average acts as a filter, for me at least. That's what I teach in my charting course, on the swing line. Add to that that momentum's trying to correct, and you just have what I call a mess on the chart. You know, one of the things that I love to do is in my mornings, I sit down and I record a video. It's literally the first active thing that I'm doing in the morning. I prep for about an hour before then, and then I sit at my computer, and my charts look just like this. They don't look like the ones you're seeing. And I teach you what these numbers are, and I reinforce what I teach in my charting course. But the beauty is I do it in a sequence that you're able to follow, and you stay with that sequence. Why? I try to cover all the different market sectors. And this tape is built for those of you that wonder, gee, I want to make this trade, or I'm thinking about doing something. I wish I had somebody or somebody else's idea to give me something. That's where this comes into play. I cover all these sectors for you, and you can skip on the bottom by just pulling it back and forth so you get where you want to go. Now, unlike what you're watching right now, I am able to talk real chart action, what I see the pros doing, both the technicals and fundamentals, but what I can't do here is what I can do in this tape. Buy here, sell there, put your stop here, take your profit there. Here's another setup on an option idea. Here's something somewhere else. So I'm throwing those ideas at you. I can even talk seasonal studies there that I do a lot of. So I wrap it up, and ideally, it's in your hand by 9 a.m. in the morning, Central Standard Time, and as the markets are going, you see what I'm doing, why I'm doing it, and away you go. The cost of it, come on, it's a joke. It's 26 cents a day. That's what I make it. I want you to see if you like it. Then if you like it, I even sell a 1-year subscription to this, really inexpensive, so that you're able to stay up and see what I'm doing. How do you find out about it? Either call my staff. You can go to our website as well. If you get onto IraEpstein.com, go under Research or Education, down to the morning subscriber video. Away you go. I'm Ira Epstein. You have a good day.